I'm Mark Learmonth, Caledonia Mining's Chief Financial Officer, and I'm going to run you through a very brief presentation giving you some highlights from our results for the quarter ended 30th of September 2019. Before we go into the presentation, there is a brief disclaimer. And also, really, before we get into the presentation, by way of background, I'd just like to give some general information about the company. We're a profitable gold producer. Our main asset, our only asset at the moment, is the Blanket mine in the south of Zimbabwe. We're a Jersey-based company. We moved out of Canada in 2016, so Jersey gives us a tax-neutral environment for the holding company. We have about $8 million of cash at the end of September. And we're trading on a PE of about just less than nine times 2019 earnings. And just in terms of our historic performance, you can see that our production has been running at anything from 50,000 to 56,000 ounces since 2016. This year, our guidance is between 50 and 53, based on some quite strong results in September and October and into November. We're probably going to come at the top end of that range. Next year, we're looking at 75,000 ounces, and our target is 80,000 ounces from 2022 onwards as we finish the central shaft. All-in sustaining costs coming down from just under $1,000 an ounce, and we're targeting anything between $700 and $800 an ounce when we hit our target run rate of 80,000 ounces. We've got 800,000 ounces of M&I resources and just less than 1 million of inferred resources. And we're getting to the end now of a fully funded 5-year investment program, which the main element of which is sinking a new shaft from surface down to just over 1.2 kilometres below surface. That shaft sinking was finished in July, and we're now busy equipping the shaft. We pay a dividend. We pay a quarterly dividend of 6 7/8 US cents per quarter, and we're currently on a yield of about 3.4%. Okay, turning to page 5, what you see here is a summary of the Q3 results. First thing to talk about is gold production, and it doesn't look very exceptional. Production in the third quarter 2019 was slightly lower than the comparable quarter 2018, but that hides some quite significant developments in the quarter. The first month of the third quarter, so August, and into July and August were shocking months, largely because of the very difficult electricity supply situation in Zimbabwe. We ran the standby diesel generators in July and August more than we did in the whole of 2018 because of quite extensive load shedding. So production in July was just less than 4,000 ounces, which means that production in August and September was 9,600 ounces, which on an annualized basis is about 58,000 ounces a year. That performance continued through into October and also the first few weeks of November. In October, we produced about 5,600 ounces, which equates to a run rate of over 65,000 ounces a year. So a very significant turnaround in production in the quarter, and I've got a little bit of information on that later on. On-mine costs remain stable. The all-in sustaining cost looks to have gone up quite significantly from about $750 an ounce in the third quarter of 2018 to $872. But don't forget, in the third quarter of 2018, the all-in sustaining cost benefited by about $120 an ounce as a result of the export incentive credit. That's when the Zimbabwe government was paying us a premium to the gold price, encouraging us to produce more. And also the all-in sustaining cost in this quarter, quarter 3 2019, was adversely affected by the higher gold price and the higher royalty that we paid to the Zim government. So adjusting for those, the all-in sustaining cost actually came down marginally in quarter 3 2019 compared to 2018. The other thing to notice is that the net profit attributable to shareholders is up very substantially from about 2.2 million to 7 million. That includes a very substantial foreign exchange gain, mainly unrealized. About $3.3 million in the quarter, and year to date about $28 million. So very substantial foreign exchange gains, which boost the net profit attributable to shareholders. When we come to calculating the adjusted earnings per share, we strip out the unrealized profits, but we still include the realized losses. And the realized losses for the 9 months to the end of September equate to about 28 cents a share. So if you're to add that 28 cents a share to the profit for the 9 months of just under 70, that gets you back to nearly $1 a share, which is comparable with the profits for the previous year. And strong cash performance. We had about $8 million at the end of the quarter, and the cash generation remains very robust. But I've got a little bit more information about that later on. Turning to page 6, you see here this summary profit and loss account. Just a few points to note here. Clearly, revenue for the quarter was up from about 16.6 million to just under 20 million. That's largely driven by the gold price, which was significantly higher. Production costs for the quarter 3 this year compared to quarter 3 last year were broadly stable. But if you look for the 9 months, you will see that there is a slight reduction in the production costs this year compared to last year, and that's because in quarter 2 we benefited from an artificially low electricity price. Whilst we're still paying electricity in local currency, that's now been adjusted to paying in effectively US dollars. But we did benefit in that quarter 2 from lower costs. The other thing that's worth noting is that this quarter the other income fell away completely. So whereas this quarter it was only $5,000, in the previous quarters it was an income of about 1.7 million. That reflects the cessation of the export credit incentive program that the Zimbabwe Reserve Bank was offering in previous quarters. As the gold price has increased, we've gone through their gold price support limit, and so the export incentive credit has fallen by the wayside. Not particularly relevant for this quarter, but certainly for the 9 months is other income. You can see we've got about $4.6 million. That really relates to the profit that we realised on the sale of a subsidiary in South Africa earlier in the year. And I guess the final thing to note here is the taxation has come down quite significantly. So in quarter 3 of this year, the effective tax rate was about 18%, compared to about 28% in the third quarter of 2018, and that's reflected year to date as well. And that's largely because the effect of the unrealised foreign exchange gains and losses has a countervailing effect on deferred tax, which actually gives rise to deferred tax credits instead of deferred tax charges, which we've had historically, and so that does bring the effective tax charge down. Turning to page 7. What you see here is the cash flow. Again, robust cash flows. The critical item to notice here is the working capital movement, which I think we'll go into a little bit more detail on when we consider the balance sheet. Tax payments down substantially from about $2.6 million, now less than about $600,000, and that relates to the basis on which we now calculate our tax in Zimbabwe. Our tax is calculated based on Zimbabwe dollar accounts, which gives rise to a lower tax charge than if we were doing it on the basis of US dollar accounts. And cash flows from investing activities. We're still investing considerably in the business. This year, in the 9 months, we did just less than $15 million. And that includes about $1.5 million of extra capex that we had to spend at short notice on additional generators to deal with the electricity supply problems in July and August. So cash position at the end of the quarter was very strong at $8 million, and we're very comfortable with that. Turning to the balance sheet on page 8. There's a few points to note here. Clearly the fixed assets up from $97 million to just under $110 million, and that reflects the ongoing substantial investment in the central shaft, which is now in its final year. Looking at current assets and current liabilities, current assets have gone up, partly because we're now holding more stock at the mine, as we're having to procure more stuff from South Africa, given logistical issues. We need to hold more stock at the mine. Also, we're holding a large amount of steel at the mine, which we'll be using in coming months to equip the central shaft. And then current liabilities, they've gone down, largely because of the withdrawal of supplier credit in Zimbabwe because of the very high inflation rate there. So you have seen a reversal in working capital in the quarter, but nothing particularly to be worried about. Turning to page 9, all page 9 does is it tries to show how we move from consolidated IFRS earnings per share, earnings of about 8.5 million, to adjusted profit of about 1.7 million. So we take out the non-controlling interest, which is the minority interests attributable to the Zimbabwean shareholders in Blanket Mine. And then you can see the very substantial adjustment in respect of the unrealised foreign exchange gains. And we're not taking them out because they're gains, we're taking them out because they are unrealised. If they were losses, we would adjust for them as well. The large components in those gains relate to the restatement of a deferred tax liability and to the erosion of a term loan facility, a $6 million term loan facility. Those amounts will be realised in coming years. The term loan falls due for repayment at the end of 2021, and the deferred tax liability will start to erode when we bring the central shaft into production late 2021 onwards. So those unrealised foreign exchange gains will in due course become realised. Turning to page 10. This really gives a little bit of information about the key drivers behind production. And the top line is quarterly tonnes milled. And you can see whilst it moves around a little bit from quarter to quarter, we've kind of plateaued at around 140,000 tonnes milled per quarter, which, given the current capacity constraints before we get the central shaft going, is pretty much the most we can do. And you can see that over the course of the last few years, the grade has come down quite substantially from over 4 grams a tonne to just over 3 grams a tonne. And what we've seen in the last quarter and into October and November is the grade has now begun to improve. And that reflects some management changes we've put in at the mine to reduce mining dilution, some much tighter controls over the day-to-day mining activities of the miners, and also we've changed somewhat the bonus system for the miners so that they are much more directly rewarded or not rewarded based on their mining accuracy and the gold produced. Turning to page 11. This just gives an outlook. We split it into sort of the short term, the medium term, and the long term. In the short term, in the course before the end of next year, we expect to commission the central shaft and start to see production increase from the current level of sort of the 55,000 ounces or so up to 75,000 ounces in 2021 and 80,000 ounces in 2022. Medium term, we have already identified some quite attractive new investment opportunities in Zimbabwe. We hope to be able to get our hands on some or all of those in the coming months, and perhaps start some exploration work on those in the near term. Medium term, we'll do further exploration work, and over the longer term, we would hope to be able to turn those opportunities to account and targeting ourselves to become a mid-tier producer, producing anything from 250,000 ounces a year to 500,000 ounces a year. I think we've spoken in the past about some of the new opportunities in Zimbabwe, and there really are some very, very attractive opportunities, and we believe we're well placed to get our hands on them. So that's the end of the review of the Q3 results. If anybody has any specific questions, we're always available on the telephone or by email. So thank you very much, and our Q4 results will be published in the middle of March next year. Thank you.